In this video, we're going to talk a little bit more about some analysis of capital budgeting itself, the process. And we'll start by talking about something called break-even analysis. And there's three typical ways that we can analyze the break-even in capital budgeting. We can do what's referred to as look at the accounting break-even. This is the sales volume at which net income would equal zero. The cash break-even analysis looks at the sales volume in which operating cash flow would be zero. And the financial break-even is the sales volume at which net present value equals zero. So these are all essentially risk analyses trying to determine the minimum amount of sales to achieve a certain goal. For instance, what is the minimum level of sales volume that we would have a net present value equal to zero? So another way, again, to talk about our forecast, again, we would talk about this break-even analysis. The way to start this is to start it by looking at the break-even analysis for operating cash flow. Now, how that is calculated is by working backwards. Now, we can do this with the solver function, or we can do it with the what-if analysis, but we just need to find that cash flow that gives us operating cash flow equal to zero. So in this case, we have the operating cash flow is $504.75. So if you subtract in the depreciation, that gives us $104.75 as net income. And then, of course, we work backwards. So what is the tax? Well, $104.75, if you multiply that or divide that by the 1 minus the tax bracket, that will tell you the tax that needs to be paid. In this case, it was 21%. If you add those two together, we get 132.59. Working your way back, that should give us the revenue here of $5,332.59 will give us the break-even revenue to get operating cash flow equal to zero. So now that we have this cash break-even, or the break-even to get the cash flow to zero, the original plan of this company was to generate revenue of $7 billion by selling this cure at $10 a dose, which means they need to sell 700 million doses. So how can we get to the break-even point with the price of only, or what is the price that we need to get to? So 53.32, if that equals 700 million times the break-even price, the break-even price is $7.62 a dose. So if we can at least sell for $7.62, we would have a break-even point. And again, this is what break-even is all about. It's a level of input that's level to, that causes the net present value or some other variable, such as operating cash flow or net income, to equal zero itself. Again, we can do this in the solver function by setting the objective for that variable, whichever one you choose, to be equal to zero, and then select the changing variable in the question. So in this comprehensive problem that we went through in a previous video, this doesn't work very well because the variables change every time you do an iteration. The variables all change. So again, this is a function, if you will, of risk analysis that allows us to look at minimum values needed to generate certain kinds of income. So for this company, HomeNet, that was devising this, the units sold, 79,000 is the break-even units. Wholesale price 232, cost of goods sold 138, cost of capital 24.1. So all of these break-even levels will provide us with an answer of the minimum amount needed in order to achieve a certain goal or a certain value. Another type of analysis we can do requires higher levels of computers than usually what we have available in Excel. But essentially what the Monte Carlo simulation is it allows us to automatically change all the variables, all within some statistical analysis that we provide. And we'll do this hundreds and hundreds and hundreds of times, and then calculate the capital budgeting, the averages, and the statistics from there. So we end up with this analysis, much like we did with sensitivity analysis, where we end up with the average and the standard deviation. But this is derived from maybe doing the analysis 5,000 times and then looking at statistically what the average and the standard deviation of those numbers is. So again, this is a relatively new kind of analysis. It works well in some industries, as they say. It seems to work well in pharmaceuticals, but it doesn't always work in every single industry. So the last couple things that we want to talk about, one is the introduction of something called real options. So again, we had this project with HomeNet that basically said, hey, this is what we're going to do. But what if there were some other options? What if they had the option to double the size? Or what if they had the option to do it in another country, right? So all of these options, right, they have value, they have an impact because they are part of the decision. We don't know whether they'll happen or not, but they are part of the decision. So if you think about it, there are three basic kinds of options we can talk about. There's an option to expand, right? If it turns out that this is really good, we have an option. Do we have an option to make it bigger? Yes. Option to abandon. If it turns out to be a dud, right? Well, how do we get out of this? What's the time frame that we need to get out of this and make this decision so we can save the company some money? And of course, then there's also an option to delay. So if variables are changing, maybe we want to delay till this change essentially goes through its steps so we ultimately can have a way to maybe delay the project 2 years down the road. All of these things are options. All of these things we have the ability to analyze and try to figure out how they affect the overall decision of the company. So to calculate this, the market value of a product, right? What is it really worth? It's worth its net present value plus the value of any option, right? So the desirability of a specialized machine versus something a little bit more versatile, right? Do we pick something that can only do a couple of things, or do we pick something that can do a lot of things? If they both cost about the same and they last about the same amount of time, the more versatile machine is more valuable because it has more options. So the one option that we do want to spend a little time talking about is the abandonment analysis. This looks at the desirability of using the project through a variety of lifespans, right? So what should we do with the project? When is the best time to do this project? So we need to estimate the salvage value of the project at each year end. Then we calculate the capital budgeting techniques to identify the optimal lifespan for each consecutive period of time. This will give us what we refer to as the optimal lifespan or the engineering lifespan. So here we have an example where we have a project. Here's the cash flows. And now we have actually estimated the salvage value for each year of the project's life. Now, the one assumption we have here is this last year, whatever the last year is, we're assuming that this last $20,000, we're assuming that it already incorporates the salvage value for the last year of the project's life. It's just a little trick we had to do to make the spreadsheet work. So again, we spent this money. If we only do it for 1 year, we spent $100,000, we made $50,000 from the project, we sold the project and made $85,000. So negative $100,000, then the first year's cash flows would have been $135,000. What is that net present value? $17,391. We have the internal rate of return, we have the modified, we have the profitability index, right? So here are our techniques. This is all done with a worksheet. It's part of the capital budgeting technique analysis sheet. It's also referred to as the abandonment analysis. So then as you look across our data, we find out that year 4 has the highest net present value. So the optimal lifespan of this project is project 4 because it has the highest net present value for this project. Any time frame here is good. We'll make money regardless of how many years we do it. But if things start to look a little sketchy, 4 years is how long we should do this project. So that is essentially one of the ways that we can look at these options. The option in this case to abandon the project sometime in the future, or just to correct, if you will, the actual best time for the project's life. So now what we would do then, of course, at the end of the 4th year, we would do this project over again because we're not going to stop the business. It's a 4-year project, and at every 4 years, we would repeat this project and gain roughly $41,000 each time we did it. So that's this video, and I look forward to talking to you next time.